Going today, we're going to talk about the non-current assets, tangibles and intangibles. And now here we can see the index. So first we will talk about the non-current assets. What are they? Then we will see the initial valuation of the tangible assets with the cost principle. Then we will see the depreciation of tangible assets. What are they? The calculation with the straight line method and how to record the entry. Then we will see the disposal or sale. And finally, what are the intangible assets?
Definition of non-current assets. Non-current assets are assets held for use in the production or supply goods or services, for rental to others. They are classified as intangible assets, are non-monetary fixed assets without physical substance. Examples of such assets include goodwill and intellectual property, such as trademarks, patents, and copyrights. Tangible assets are non-monetary fixed assets with physical substance. Examples of such assets are real estate properties, manufacturing plants, land, equipment, and other tangible or fixed items. Long-term financial investments are financial assets of a long-term nature. Long-term credits are examples of long-term financial assets. Initial valuation of tangible assets, cost principle. If it has been bought outside, acquisition cost. That is the cost of the asset, including all expenditures necessary to get the asset in place. If it has been produced by the company, manufacturing cost. That is the cost of raw materials plus direct labor cost plus overhead costs necessary to manufacture a product.
So here we're going to see what amortization or depreciation is about. So the assets are put on the balance sheet and then written off as expenses over the accounting periods in which they are used to generate revenue. The written off expense is called amortization or depreciation. Land is not depreciated, neither assets under construction. And the calculation of depreciation or amortization requires the following data: the cost of the asset, that can be the acquisition or manufacturing cost, the estimated useful life, that is the working life, and the estimated residual value, the salvage value. And we use the straight line method to calculate depreciation or amortization. And the entry in the journal book is always the same: the quantity, amortization, then accumulative amortization, and the quantity, or quantity, depreciation, and then accumulative depreciation, and then the quantity. Now we can see the different type of value losses. We have amortization, depreciation, and impairment. First, we're going to see the systematic losses, which is amortization is used for intangible assets and depreciation for tangible assets. We record depreciation for furniture, vehicles, but not for land. And we can see the depreciation or amortization formula using the straight line method. Second of all, we see the potential and non-systematic losses, which is the impairment. That is when we go to the market and we check that the fair value in the market is lower than our book value. We have to compare the book value, which is the value of books, which is the value we have on our balance sheet, comparing it with the market value. So if market value is lower than book value, we call an impairment. The difference between systematic and non-systematic losses is that the non-systematic losses could happen. We don't know why, maybe due to the market trends, but we can't return back. It is a reversal. Impairment does not have formula, but we compare the value of what we have on our balance sheet comparing to the market. If we have a priori impairment in the previous period, if the value is higher on the market, we have to close the impairment. We can see an example. If we have a computer of 10,000 euros with an accumulated depreciation of 6,000, it means that the book value is 4,000. And if at the end of the period we go to the market and we see that the market value is 7,000, then we have a potential gain of 3,000 and we do not record it. But in the second case, if the market value is 3,000, we have potential losses of 1,000 euros and we record it. Finally, we have definitive losses that are the non-systematic and unexpected losses suffered by assets. It is when something is broken. For example, if our hot dog machine of our company is broken and you cannot use it anymore to make your delicious hot dogs. Just so that you have everything. Just so that you have everything clear, we're going to see an example. So if you're a company and you have a gummy bear machine of 11,500 euros and it has a useful life of 6 years and a residual value of 500 euros with installation costs of 1,000 euros, and they tell you to calculate annual depreciation, we're going to use a straight line method to calculate the depreciation. So substituting the numbers on the formula, we see that the cost of the asset, that is 11,500 euros, subtracting it from the expected residual value, which is 500 euros, over the expected useful life, which is 6 years, it gives us a 2,000 euros annual depreciation. And we put it on our journal book, recording it as 2,000 euros as quantity, depreciation expense, to accumulated depreciation, 2,000 euros.
Okay, so now we're gonna talk about the disposal, sale, or retirement of tangible assets. As we all know, tangible assets can be characterized by having a physical appearance and they're often easily transacted for a monetary value, depending on how close they are to liquidity. Definitely, tangible assets are what a company uses to operate the business, from fixed ones that are used for more than one accounting period, such as hardware, machines, or desks, to non-fixed ones, used for the production of final goods or services, such as, for example, inventory or raw materials. Firstly, tangible assets are listed on the balance sheet, but they find their way eventually into income statement, which depending on the type will become part of cost of goods sold entry in the case of non-fixed assets, or in the case of the fixed ones, which make their way through depreciation. Depreciation is a process that only affects fixed assets. Those over its time of use lose value. So this is a way of reflecting the cost of the asset over its useful life.
In topic 8.5, they talk about intangible assets. And intangible assets are assets that have no physical substance. They are rights to the owner. They are recorded at cost and can have finite or indefinite. Different kinds of intangible assets can be patents, copyrights, trademarks, franchise agreements, licenses, or goodwill. Also, intangible assets expire, so they must be amortized. Their amortization expense and accumulated amortization are recorded in the same way as the depreciation for intangible assets. Straight line method use it to record their amortization. Also here at your right, you can see a balance sheet example, and here you can see the intangible assets.
All right, so thank you very much